What's up, everybody, and welcome back to Trade With Me, where I do the research and you can choose to buy the stock or move on. So what we're looking at today is Castor Maritime, and we've been talking about this earning report for such a long time. If you go back to some of my previous videos, I tried to do a deep dive into their Q3 earnings reports about a month ago, and we tried to figure out what is Castor Maritime up to. They keep buying these ships. What is the financial side looking at? And there's some good and some bad. This is pretty much as impartial as I can be. I don't currently own stock in Castor Maritime. I am looking to enter though. I bought stocks back in, I believe it was January. I bought some more in February, and I recently de-risked my portfolio and got out around the 94-cent mark. But I do want to get back in because I do believe in the company. So where did we leave off? We had about $40 million in current assets. You obviously know they've been buying a buttload of ships, so obviously our assets will be going up. Let's take a look at the actual sheet. So they told us now they have about $74 million in current assets. Vessels alone is worth $58 million. We also have some financing fees. We have some common stock. All good things, right? This is all, we have positive asset growth. Those assets do depreciate, but they make you money, right? It's a shipping company. They should have ships, and they have $74 million worth of ships. That's pretty stinking good to me. The fleet alone could, when it is being used to its maximum potential, gross about $137,000 a day, and this is up from Q3. It's doubled, right? They were at $64,700 in Q3. They're now at $137,000 a day when fully used. Now, the catch is this Wonder Series, these Wonder Polaris and Wonder Sirius, they profit share on this, which I didn't read that anywhere. And if you look at the press release that Castor Maritime gave to investors, they don't mention that in there either. But if you go into the SEC report, it's right there, profit sharing, and they go on to say that they share profits on these two ships. I didn't know that. I think it's interesting, just not really a big deal, but I just, kind of weird. The outlook, the dry bulk shipping market, according to them, is steadily improving. The market participants expect a robust rate and environment throughout 2021, which, if it materializes, it is expected to drive our revenues higher. Right now, dry bulk is taking a little bit of a downtrend, but, we had the blockage in the Suez Canal. It could be a whole bunch of things, but it's pretty much at all-time highs, at least for this year, so they're not wrong about that. Now, let's get into the bad. The global economic crisis has negatively impacted them in ways that we really didn't expect, right? They have lower charter rates than expected, particularly for vessels employed on short-term time charters, which is what they have. The decreases in market value of the vessels themselves. Limited financing for vessels. Banks are just simply not giving them what they need. Widespread loan covenant defaults. Declaration of bankruptcy for certain vessel operators, vessel owners, and shipyards and charters. So there's some big problems happening in the shipping industry that they just have to deal with as a company. Not great. Also, COVID-19 specifically has been a huge problem for them. The way it was written in the SEC report, and they didn't give this in the press release, so I retyped it for you, but this is word for word what they said. Decrease in demand for shipping, delays in loading and unloading cargo, there's credit tightening, decrease in market value of their vessels again, quarantine restrictions for crews, which obviously we're all living in this pandemic, we understand, but that means their ships are stuck in port more than they'd like to be, and international travel restrictions as well. They're having trouble just getting crews on and off the ships and back to their homes. And if anybody owns a business right now and they're trying to hire people, it's been pretty tough just hiring. So I could see where they're coming from, where it's hard to get the crew, it's hard to get the ships going. This is not ideal conditions. Also, they're specifically stuck in port. They talk about During 2020 and up to date the press release, we encountered certain instances of prolonged delays of embarking and disembarking crew onto our ships associated with deviation time for quarantine checks, waiting time for various ports where crew changes were affected, positioning our vessels to countries in which we can rotate crew in compliance with these measures. These delays are deviations and have resulted in increased operating expenses, and that is all throughout the report. Expenses have gone up considerably, not just because they bought the ships, but because it's taking a lot longer in port to unload, offload, get the bulk carrier on there, get the crew on there, and get out of port. They said these are significant hurdles faced with crew changes, and reparation of seafarers has further led to growing humanitarian crisis as well as significant concerns for the safety of the seafarers. So just like all of us, COVID's taken a hit, and it's taken a hit on Castor Maritime, and they're being honest with you. Also, charter rates themselves, they say, caused an impact on our vessel revenues during 2020. Certain vessels were employed at comparably less favorable charter rates because of the COVID-19 pandemic. Hopefully we're getting out of this pandemic soon. Hopefully things will subside. But as of right now, it's still a problem. These short-term contracts are just not paying what they're expected. And then we have the problem of Nasdaq Compliance. If you're on stock to it, so it's all you heard about for March. And they did not gain compliance. They were not above $1 for long enough to really gain it. They're now down around 77, 78 cents. And they put this word in there, a reverse stock split, which they are considering in order to get to $1 per share. They have until June 28th, 2021 to regain compliance on the Nasdaq. They probably can do that without a stock split. They're not that far away. A reverse stock split does have a negative reputation, but it can release selling pressure, show shareholders they care, and help keep them on the exchange. So, next we have fleet utilization and TCE, right? TCE is like a good metric to judge a company's ability to ship dry bulk, and their TCE is down, which is not ideal, but again, it's because of these time in port that they're stuck. Also, fleet utilization. They're not even able to get contracts for all their ships all of the time. I mean, they were running in 2019 97, 98% tight. Now they're running 82% the last 3 months and 87% for the year. That is concerning. I mean, that's really all you can say about it, right? I mean, if the ships are not working, they're just sitting there, they're just costing money. So what is the outlook for this company? And I love this company, I'm not going to lie to you. But I got to say, there's some growing pains that you got to watch this company. If you own shares, I would hold on to them. If you're not in it yet, I would wait. All right, they're going to be a good investment. They have so much potential, right? This whole fleet is tremendous. But you got to watch COVID-19, you got to watch your oil prices, and you got to watch your shipping rates. And you got to watch for them to get near or at Nasdaq compliance by June. Otherwise, you know that reverse stock split is coming. So, I hope you like this video. Please like it, leave a comment, subscribe, trade with me, where I do the research and you reap the rewards. Thanks for watching. And if you have any suggestions, please let me know to make a video for you. Bye.